Are you thinking about buying an investment property, but you're like, there's no way that I could qualify for another mortgage? A lot of people miss this unique opportunity. It's truly an investment hack. So if you're in the market and you want to become an investor, or maybe you're already an investor and you're starting to push into the traditional mainstream loan guidelines, or you're just like, I don't want to jump through the hoops. I don't want to have to put forth all of my tax returns or W-2s or things like that. There is a loan out there, and that loan is called a DSCR loan. What does that stand for? Well, it stands for debt service coverage ratio. So it's a whole different approach to financing. This is for residential properties. It is for investment properties. And it could be used for Airbnb or short-term rentals as well. The difference on this is that this is a no income qualifying loan. The property and the projected rental income on that property is what qualifies for the loan. Yes, you have to have a credit score. Yes, credit score matters and drives the interest rate. Yes, you're going to have to put down 20 to 30%. All of that is yes, yes, yes. But the sticking point with so many people on wanting to acquire investment properties is really the income documentation, especially if you're self-employed. Because if you're self-employed, very likely your gross receipts versus your net receipts on that tax return are going to be materially different. So this solves that type of equation. It allows you to qualify based on what that property revenue is going to be. So let's walk through it. What does that really mean? What am I saying? Blah, 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 right? So let's say that the rental income is $2,000 a month. So the rental area and that projected rental income is going to be a factor on this loan. Let's say that the house payment itself is going to be $2,000 a month. And so that's house payment, HOA, solar if there is solar, property taxes, homeowners insurance, PITI, out the door, $2,000 a month. That's going to be a debt service coverage ratio of 1%, which means that the rental income on the property offsets the total payment on the property. So essentially it's a wash. That's a good thing. In that scenario, you can qualify. So let's start to look at where that starts to get off track. Let's say that the rental income is $2,000 a month, but the payment all in is $2,500 a month. Now you're in a negative debt service coverage ratio number. And it doesn't mean that you can't qualify. It just means that the strategy and the way we go about it, these loans have a lot of different moving pieces. So ideally, you're at that 1% ratio, but there are scenarios that allow for a no ratio calculation, that allow for a higher ratio at 1.25, that could actually benefit your payment or your interest rate or the term. So lots of navigation here, but really at the end of the day, it's just important to know that this is a unique residential mortgage designed specifically for investors that want to acquire property. Maybe you're a small builder and you want to acquire property. You're going to do some type of renovation on it. Maybe you're an investor. You're just wanting to build wealth through real estate. This is the loan that allows you to do that without having to provide traditional income documentation. What are a couple of other things? One, you can close in an LLC, which is unique. So you can close in your own personal name, or again, close in an LLC. Lots of our investors want to close in LLCs for other reasons. So this loan will allow you to do that. There's no reserves generally, especially if you're doing a cash out refinance. So if you're doing a cash out refinance, it's important to know this isn't just for purchases. You can actually do a refinance with a debt service coverage ratio loan. The cash out and a cash out refinance, maybe you're wanting to liquidate, take some of it back out, go to buy another property. The cash out itself would cover the reserve requirement on the program. When I say reserves, when you're using a traditional, let's say Fannie Mae, Freddie Mac loan, and you're buying an investment property, the lender and the guidelines are going to want to see not just your down payment, not just your closing costs, but they're going to want to see a number of months of reserves for that property and potentially other properties you own. So if you think about it, if the payment on this property is $2,000 a month, and then you own 4 other properties at $2,000 a month, now you've got net payments of $8,000 a month. The lender may want to have a variety of reserves. Could be 2 months for your primary residence, could be 6 months for the property you're acquiring, could be 3 months for the other properties. In this scenario, it doesn't work that way. So again, we're falling out of traditional mainstream guidelines and we're getting into a program. It's truly an investor hack. It is designed for investors to build wealth. Traditional purchase scenario would like to see 3 months reserves post your down payment and closing costs. Generally, for our investors, that's not a big deal. And it's on the subject property. But again, I do want to make sure that if you're an investor out there and you own property and you want to tap into some of that equity, this program works. And with interest rates coming down over the last few months, this could be a prime time to not just tap into the equity, but also potentially lower your interest rate. I just talked about a whole lot of pros, right? Not having to produce tax returns, W-2s, and all that stuff. That's a pro. What are the cons? Well, the cons are this is a risk-based loan. It's a make sense loan. So the interest rates are going to be slightly higher than if you were to provide all the documentation and use a traditional conforming conventional loan that's being sold to Fannie Mae or Freddie Mac. So different strategy. So interest rates a little bit higher. The down payment is going to be more than what you would need on a conventional investment property. On a conventional conforming loan, you can do a 15% down payment. On the debt service coverage ratio loan, you would have to put a minimum of 20 to 25% down, maybe even 30% if you're wanting to get that interest rate lower. So it's more of a down payment asset-based type of scenario. Back on the conventional conforming traditional mainstream loan, again, that loan's going to want reserves. That loan's going to want an automated loan approval. That loan is going to require full personal income to qualify for the loan. The debt service coverage ratio loan doesn't, because again, the property's revenue that it's generating through the rental income is what is qualifying for the loan. It's pretty cool. So if you're curious and you're like, I want to buy an investment property. Yes, I want to build wealth through real estate. I hear everybody talking about it. I just don't know how to do it. Now's the day. Feel free to reach out, 480-725-0150, and we'll connect you with a KellyZitlowGroup advisor who specializes in this program. And as a reminder, we lend all across the country. So if you think, I do want to learn more about how I can leverage this type of loan program to build wealth through real estate, now's the time. We look forward to chatting with you. If you found value in this, please like or subscribe. And I would love to have your comments. I mean, this is important to get the word out that this type of program does exist for the investors out there that want to build wealth through real estate.